Hello from me, Kevin French at Core Wealth. We are 2/3 of the way through 2025 and we're going to have a look at what's been happening in financial markets for August of 2025 and have a look ahead. So August was quite a good month for global equity markets. If we look at the developed market equity index, it was up over 2.6%, and this was driven by the US having another good month, and we saw in particular the healthcare sector in the US up strongly, and this was because Warren Buffett's company had made a bid for United Healthcare in the United States. In addition to that, we saw the smaller cap indices up quite strongly, some 7% for the month, and this has been in quite sharp contrast to what we've seen in the past, where the large companies, the Magnificent Seven you've heard us talk about, were the strong drivers of US equity markets. At the same time, we've seen the US economy starting to show signs of slowing down. Their job creation numbers that came out over the last couple of months have been softer. Because of that, we've seen the US bond market, the yields come down. That's good for bondholders, and that's been in anticipation that interest rates are going to start to come down. And we saw on the back of that the US dollar weakened, and we've seen the gold price rising because of that. Emerging markets were slightly softer than their developed market counterparts, up some 1.3% for the month, but are up 19% so far year to date. And a lot of this has come from China. If we have a look at the excitement around China, it's up over 38% in the last year. And that's been in anticipation of, firstly, some of the stimulus and excitement around chip manufacturing that the government is trying to push in China. While at the moment, the economy looks a bit soft in that there's concerns around their property market, and their manufacturing is not as high as it has been. But the market is excited about some of these new developments and the stimulus that they expect could come from that. By contrast, the European equity markets were slightly softer during the month, in particular France and Germany. This was on the back of just concerns around some of the political wranglings and things that were happening in those countries. But if we have a look over the last number of years, I'll show you in coming slides that Europe has actually been one of the best places to have been invested from an equity point of view. At the moment, their economy is looking quite good. From a macroeconomic point of view, they are on target in terms of inflation. The South African stock market had a good month, was up some 3.5%. That's the 6th month in a row that they've had positive returns in South Africa. And if we have a look at what drove that, for the month of August, 3/4 of that return came from the gold mining companies on the Johannesburg Stock Exchange. If we have a look at the year-to-date figures, half of the return of the Johannesburg Stock Exchange came from gold miners and platinum mining companies, just showing you the impact of how those prices of the precious metal has driven the South African companies. Headline inflation came out at 3.5% during the month, which is higher than what we've seen over the last little while. Most of it was driven by food inflation, which we think will change going forward. Our core inflation is at around 3%, and we expect through time that we'll be successful in targeting that as a country. Well, have a look at all the green on this slide. This shows global markets for the month, all of them up very strongly. The standout ones really in the east, and we can see there that the Chinese equity market's up over 11%, the Japanese equity market's up almost 7%, so really strong month. If you just let your eye follow the 1-year number, what's interesting there is that over the last year, the best placed in terms of developed markets to have been invested was actually the UK equity market. Emerging markets, we referred to this a little bit earlier. The Chinese equity market over the last year up some 38.2%. So really strong moves there. Over the longer term, what's quite interesting to have a look at here is that US equity markets, remember this number, 14.7% over the last 5 years and 14.6% over the last 10 years. And I'll refer to that in our next slide. So if we have a look at the South African equity markets for our South African clients, these numbers are shown in South African rands. The previous slide was in dollars. Now, having a look for the month, you can see it's been quite a good month in terms of our equity markets, up strongly, listed property up 2.8%, and the rand actually strengthened against the pound and against the US dollar. Over the last year, again, you can see some really good returns. The Johannesburg Stock Exchange up almost 26% over the last year. But then listed properties also done well, and so is our bond market at just over 15%. I asked you to remember the 5-year number was 14.7% for the S&P 500 over the last 5 years. If you wanted to convert that to rands, you add back what the rand is depreciated by, which is 0.9%. So you've got, if you invested in the S&P 500, you got 15.6% per year over the last 5 years. However, if you invested in the JSE All Share Index, you got 17.2%. So actually, over the last 5 years, you did better being invested in South Africa on the JSE than you did being invested in the S&P 500. Interesting. So let's have a look at how the core wealth global strategies have performed. We'll start with our US dollar strategies. And so here we can see the last year has been really good, some really strong outperformance of the peer groups. But what is really encouraging to see is if we look at the last 5 years, we've averaged between 2 and 3% per year outperformance of the peer group average. So some good, strong outperformance, managers doing well, some of our tilts in there having exposure to emerging markets have worked well. So if we have a look at our UK sterling models, the ones with a shorter track record, we can see over the last year some good outperformance again of the peer groups between 1.4 and 2.1% for the last year. And the growth strategy giving you almost a 10% return in UK sterling. Although the balance strategy is underperforming the peer group over the last 3 years, still outperforms since inception. And if we're getting close to 2% outperformance as we are on our defensive strategy, some good outperformance of the peer group since inception. So here are South African models. These have been running now, some of them almost 13 years now. But what's important to see over the last 1, 3, and 5 year periods is the magnitude of both outperformance, so the figures in the green bars, as well as the actual total performance. So if we have a look at the 5-year returns for our more aggressive strategies, Core Wealth Balance, Core Wealth Retirement Growth, and Core Wealth Flexible, all of them knocking at around 15% over the last 5 years. Take into account that inflation over that same period was running at 5.1%, you've had nearly a 10% outperformance of inflation, which is significant in terms of growing clients' wealth over the longer term. So we mentioned earlier that in South Africa, the gold mining companies had accounted for a significant part of the rise in the Johannesburg Stock Exchange. We're going to take a couple of slides and have a look at what is happening to gold around the world. This graph shows gold as a percentage of total reserves of the different countries around the world. And in total, we can see that back in the 1960s, the average was over 65%. It's fallen over the years and was getting close to 5% at one stage. It rose again, and by the start of the Ukraine war in 2022, it was back up at 10%. And we've seen it rise even further. And in fact, after Liberation Day, it was up at around 15%. So when there's uncertainty in the market, that's often when you see countries adding more to their gold reserves. And we've seen that over the last while. From Liberation Day announcements around tariffs, that created uncertainty. We've seen how the reserve levels have gone up by up to 5%. Part of that is on the price, but also governments adding to their reserves. The concern, though, at the moment is more around whether the US Federal Reserve will remain independent and there won't be meddling, that political meddling that comes from the president in the current case. This graph just shows the dollar gold price over the longer term. But what we can see, if we look back to 2022, when the Russia-Ukraine crisis started, or the war started there, and there were sanctions put on Russia, we saw that Russia started buying more and more gold. And that put more demand on the gold price. And we've seen that price has gone up by some almost 38% over the last year, from $2,634 an ounce to over $3,500. Some banks are projecting that we could go over $4,000 in the next year to 18 months. Another area where we've seen additional demand coming for gold has been from China. And this graph just has a look at Chinese new house prices and whether they're going up, which is when the graph is blue, or whether they're going down, which is when the graph is red. Since 2022, we've seen that Chinese real estate or house prices have been negative. And that's what this graph is showing you. And on the back of that, we've seen real estate investors starting to add gold to their portfolios instead of real estate. And that has added further demand, pushing the gold price higher. The other big driver of demand for gold is the central banks. And here we have two graphs. The one on the left just shows you the top 10 countries who increased their reserves the most between 2019 and 2024. And we can see that the bulk of these are emerging markets, and some of them we would classify as autocratic or quasi-autocratic type states. Many of them have got issues with the United States. We can see there China, the biggest adder to reserves, India just close behind them, and you can run your eye through the other names. If we have a look at the graph on the right, that shows the total size of reserves, and we can see that the United States is by far the largest holder of gold reserves globally. But then if you have a look down to the right, those that have increased their reserves, places like Russia, China, and India, even Japan, have been further adding to their gold reserves again. Therefore, they're adding further demand for the precious metal, and that's pushing up the price. So having spoken about some of the drivers behind the gold price, has this filter through into our portfolios? And if we have a look at our South African based strategies, there we are seeing an overweight versus peers of between some 1 to 4%. If we have a look at our global strategies, we're seeing similar levels of overweight from between 1.5 to as much as 5% overweight versus the peer group. So I hope that's added to your insights into our portfolios and the way that we're thinking at the moment. If you have questions, please get hold of your financial advisor. We'd love to talk you through them. If you'd like to post a question on our social media, please add it to the comments below.